Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Today we're breaking down a really interesting one. A company that's been requested a lot, actually. It's Kelly Partners Group Holdings, or KPG on the ASX.
And on the surface, it's an aggregator of accounting firms. Sounds pretty standard, right? But the real question for us as long-term investors is this. Why is this seemingly traditional business trading at a valuation that implies it's the next big tech giant? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Let's start with that central tension you mentioned, the valuation.
Right. The market's wager on KPG is, frankly, astounding. This is where we have to begin, because the numbers immediately tell you this is not priced like your typical service firm.
Exactly. When you look at the core metric, the one we use for valuing these kinds of businesses, price to earnings, based on the run rate NPATA, it's currently sitting at approximately 38 times earnings.
38 times. Let's just pause there for a second.
Yeah.
Because you, the listener, need to really understand the gravity of that number. 38 times is a multiple usually reserved for what? Asset-light, high-growth software giants?
Or maybe world-class consumer monopolies.
Yeah.
Think Coca-Cola or Visa.
Right. It's definitely not the valuation we'd expect for a partnership that, at its core, prepares tax returns.
And that extreme valuation is the entire tension we have to resolve today. It's what you'd call a compounder premium. It suggests the market isn't just hoping KPG will grow.
No, it's demanding it.
It's demanding sustained, high-quality earnings growth, likely north of, 20% annually for the next 5, maybe 7 years. If they stumble, if they slow down even a little,
that multiple collapses brutally.
it does.
So our mission today is to stress test the foundations. We need to unpack every layer of their business model, which is famously unique, to see if it generates an economic moat powerful enough to justify that incredible expectation.
We have to look at the incentive structure, figure out if their process power is real, and then, most critically, we have to examine this massive capital allocation bet they're making right now.
Their aggressive push into the U.S. market.
The lucrative but very dangerous United States market.
Yeah.
We need to know if that 38x multiple is warranted or if it's just a classic valuation trap.
Okay, let's unpack this. Let's start with the engine itself, how they actually buy and operate these firms. You mentioned the long, ugly history of failed professional services roll-ups.
Right.
Historically, why do they fail? And how does KPG claim to have solved that fatal flaw?
Well, the fatal flaw in nearly every professional services rollout, be it legal, medical, or accounting, is what we call the agency problem, which gets coupled with human capital flight.
Okay.
A standard roll-up, they acquire a business 100%, they write a huge check to the founding partner, and then they convert that partner into an employee.
And tell them they have to stick around for a few years.
Exactly, a 3 to 5 year lockup. But the founder has already made their fortune, so their primary incentive shifts from maximizing the firm's profitability to, maximizing their personal leisure time.
Or just waiting for their non-compete to expire so they can go sit up down the street.
Precisely. The talent, the secret sauce, just walks out the door.
So KPG's model is specifically designed to stop that from happening, to prevent that human talent from disengaging.
That's the entire idea. They are an aggregator, but they are absolutely not a standard roll-up. The mechanism, which they sometimes call the black box, is actually pretty transparent when you dig in. They only acquire a 51% controlling interest in a private accounting firm.
Only 51%. So they intentionally leave a huge piece of the equity, a massive piece of the profit stream, in the hands of the original owners.
That's the critical detail. The existing partners retain that crucial 49% minority interest. This 51-49 split is their structural defense against that decay of quality and flight of talent.
Because if you still own almost half the business,
You're not an employee, you're a co-owner. Every single decision you make, from managing client relationships to hiring and training junior staff, it directly affects your personal balance sheet. It affects the wealth you're building year after year.
that makes the partner a true owner-driver. You've used this fantastic term before, the incentive Lollapalooza, to describe what this structure creates. Can you walk us through those converging forces?
Yeah, it's the convergence that makes it so potent. The Lollapalooza effect, a term from behavioral finance, is when you get multiple independent positive forces all acting together to create an outcome that's exponentially better than any single force could achieve on its own.
And for KPG, there are three main forces at play here.
Three primary forces, all generated by that 5149 structure.
Let's take the first one, skin in the game.
This is the absolute foundation. The partners are not employees. Their incentive is equity in the subsidiary business they run. They are personally financially on the hook for the P&L of their specific firm.
You can't just check out.
You can't, because checking out means shrinking the firm, and shrinking the firm means shrinking your personal wealth. It aligns interests perfectly. It also acts as a filter.
How so?
Well, it ensures KPG only acquires firms that have motivated long-term founders. The founders that just want a quick payday and a trip to the beach would never, ever agree to this model.
That makes sense. And the second force, which is so important for a high-touch service business, autonomy versus scale. How do they balance those two conflicting needs?
This is the operational magic. SME accounting clients, they demand a personal relationship. They need to trust their local partner. KPG gets this. They let the local partners keep their local brand, their client relationships, and the autonomy to run day-to-day client operations. They are the driver.
But KPG, as the owner, brings the scale.
Right. They immediately provide the centralized Big Four type resources. So the partner gets to focus on the high-value client work, and KPG handles all the expensive headaches that typically drain a small accounting firm's resources.
What kind of headaches are we talking about?
Oh, everything. They get sophisticated centralized IT systems, professional HR, standardized national marketing, all the regulatory compliance frameworks, all the stuff a small, independent firm could never afford or manage effectively. They get the benefits of scale without losing that personal, high-trust relationship clients demand.
It's the best of both worlds, really.
It's designed to be.
You mentioned the historical failures. We hear a lot about the disaster of Slater and Gordon, the big legal services roll-up. Can you elaborate on how KPG avoids that fate?
The Slater and Gordon experience is the perfect cautionary tale. They bought legal practices 100%, turning these highly successful rainmakers into salaried employees. They centralized client-facing decisions too heavily.
And the result was predictable.
Utterly. Cultural clashes, an immediate loss of that entrepreneurial spirit, and critically, the best legal talent walked straight out the door. And they often took their best clients with them to start new independent firms. KPG explicitly avoids this. That 49% stake reinforces, rather than extinguishes, the entrepreneurial fire.
Okay, this structure sounds incredibly stable, but professional services can be cyclical. What about the quality of the revenue that's actually flowing into the system?
The revenue quality is incredibly high, which is foundational to this whole compounder claim. A core part of their unit economics is that approximately 95% of their revenue is recurring.
95%.
Yeah. We are not talking about volatile, large-scale M&A advisory or one-off consulting projects. This is compliance work, tax preparation, regular bookkeeping, payroll management.
The stuff that has to get done no matter what the economy is doing.
The non-discretionary necessities of running a small or medium business. It's an annuity stream, basically.
And you mentioned their payment structure helps with that predictability as well.
It does. They actively move clients away from the traditional, volatile, hourly billing model. Instead, clients are put on monthly retainers. This just smooths out KPG's cash flow. It improves their forecasting dramatically, and it gives management tremendous visibility into future performance.
Which means they can plan their next acquisition with a lot more confidence.
With much higher confidence than a typical services firm, yes.
Before we move on to margins, let's just clarify this core metric we keep referencing, NPATA. NPATA, normalized profit after tax and amortization, is central to that 38x valuation. For listeners who might be less familiar with it, why do we use NPATA instead of just standard reported net income?
That's a crucial point. We use NPATA because KPG is a serial acquirer, so they're constantly booking acquisition-related costs. NPATA essentially strips out two things that distort the picture of ongoing operational profitability.
Okay.
First, it takes out non-recurring acquisition costs. Second, it removes the amortization of intangible assets like client lists or goodwill that get created during the acquisitions. Standard accounting requires these amortization charges, but they're often non-cash expenses that don't reflect the true cash earning power of the business.
So run rate NPATA gives us the clean, normalized number for the profitability of the whole group. It lets us do an apples-to-apples comparison to the share price.
Exactly. And that's the number, that 38 times number that we are scrutinizing today.
Understood. Now let's see the payoff. If this unique 5149 structure and the centralized scale work as well as advertised, it has to show up in the margins. They must be radically superior to the industry average.
And this is what's so fascinating. The business model translates directly into pricing power and margins that really do validate the thesis. This is the tangible evidence of their economic moat.
Give us the hard numbers on that margin differential. How wide is the gap?
So KPG consistently reports EBITDA margins, that's earnings before interest, tax, depreciation, and amortization, of roughly 30 to 35%.
30 to 35.
Now, you have to compare this to the industry average for typical independently owned SME accounting firms. That consistently sits around 15 to 20%.
Wow. So a 15 to 20 point differential, they are effectively doubling the standard industry profitability.
They are. That gap is the financial representation of their competitive advantage.
And where exactly does that 15% advantage come from? Is it just that they're charging exorbitant prices, or is it something else?
It is overwhelmingly operational excellence, though the stability does confirm they have pricing power. And this leads us directly to their primary economic moat, process power. The margin advantage comes from the ruthless efficiency of the Kelly Business System.
Okay, let's put the Kelly Business System, or KBS, under the microscope. You call it proprietary. What specifically does it standardize, and how does that process translate into a 15% cost saving over a competitor?
The Kelly Business System is their proprietary, highly systematized operating manual. And I would argue it's the single most important asset KPG owns, outside of its people. Think of it less as a manual and more as a mandatory optimized workflow blueprint.
That gets installed in every firm they buy.
Rigidly installed from day one into every single acquired firm. The key is centralization and automation.
Give me a concrete example of what that looks like in practice.
Sure. Imagine a typical independent accounting firm. They might be running, 15 different incompatible software programs for time tracking, billing, payroll, client comms, tax filing.
A total mess.
A total mess. And they have to hire local IT consultants, local HR managers, local marketing support. The KBS mandates the removal of all that inefficiency. It centralizes all non-client-facing functions under KPG's parent company.
So all billing is handled by one system.
One optimized automated system. All IT is managed through a single cloud platform. All HR onboarding, compliance, marketing templates, it's all handled centrally.
So the local partner, the 49% owner, only has to worry about one thing: maximizing client service and growing the top line, not the messy, expensive, non-revenue generating admin work.
Exactly. That immediate stripping out of redundant back-office costs is the source of the margin differential. A small independent firm just can't achieve that scale or automation.
And other potential roll-ups can't just copy it.
They can't easily replicate it. They'd need to develop their own system, have the capital to build the centralized function, and critically, have the cultural force and incentive structure, that 5149 model, to enforce standardization across a network of proud, formally independent business owners. That difficulty makes the process power a very real, tangible moat.
So the system itself acts as a barrier. Now, you mentioned a secondary moat, the classic switching costs in professional services.
That's the retention element. Accounting is inherently high trust. For you, the listener, your accountant knows your business structure, your tax strategies, your succession plans.
Often your family's deepest financial secrets.
Exactly. Changing accountants is not just a logistical hassle. It is a high-paying, high-trust decision that takes a lot of time and requires rebuilding confidence from scratch. It's the highest friction type of switching cost.
And the proof is in the numbers.
It is. Their retention rates are typically above 95%. This just cements that high-margin recurring revenue we talked about. It turns those predictable streams into a compounding annuity that constantly fuels the acquisition engine.
This inherent stability is crucial, especially now. We've seen significant wage inflation recently across all white-collar industries. If their margin depends on keeping costs low, how have they fared?
This is the ultimate test of pricing power. The fact that KPG has been able to maintain those stable 30 to 35% operating margins even during the intense wage inflation of the last couple of years is the most powerful confirmation we have of their moat.
So they're passing the costs on.
They're successfully passing on the rising cost of human capital hire accountant salaries directly to their clients without suffering attrition. That resilience confirms the process power isn't just theoretical, it's robust and protects profitability even during economic stress.
That sets the stage beautifully for looking at the financials and specifically management's track record. With any serial acquirer, the quality of the business is inseparable from the quality of management's capital allocation.
Absolutely, we need to check their report card. But first, because this is a roll-up with such a unique structure, we need to address two critical accounting traps that can mislead even sophisticated investors.
Let's start with the one most common in growth stories, stock-based compensation. Are they using massive SBC to pay for growth and diluting shareholders into oblivion?
No, KPG passes what we call the SBC reality check. They avoid the massive dilution you see in tech and SaaS roll-ups. Remember, the incentive is based on that 51-49 model. Partners get equity ownership in their subsidiary business, not massive options or stock grants in the listed parent company.
Okay, so the problem isn't dilution at the parent level, it's a cash flow reality check at the operating level. This brings us to the minority interest trap, which you flagged as the single most crucial accounting detail.
This is where so many investors go wrong when they analyze KPG. Because KPG only owns 51% of its subsidiaries, the cash earnings of those subsidiaries are reported at 100% on KPG's income statement.
Right.
However, the cash payments made to the 49% minority partners, their share of the profit, show up on the cash flow statement as minority interest payments.
And those cash payments are real. They physically leave the consolidated entity.
Precisely. They are real cash outflows that KPG shareholders never see and can't control. You, the shareholder in the listed company, only have a claim on 51% of that profit.
Yeah.
Therefore, you absolutely must subtract these payments from the reported operating cash flow to get to the true free cash flow available to KPG shareholders.
The cash that's actually available for more acquisitions or debt repayment or dividends.
Exactly. Let me give you a simple example. Imagine a subsidiary earns $100 in cash profit. KPG reports that $100 on its earnings line, but $49 of that cash has to be physically paid out to the minority partner. If you just look at the reported operating cash flow, you might think KPG has $100 to spend.
But in reality, they only have 51.
They only have $51. If you neglect to adjust for that minority interest cash outflow, you dramatically overestimate the company's actual cash-generating capability. It's a key reason why many roll-ups with similar structures can look artificially cheap on standard headline metrics.
That brings a necessary rigor to the analysis. So once we've adjusted for that reality, how does management fare on the core metric for value creation? Return on invested capital or ROIC?
This is where the compounder thesis gets its strongest validation. KPG targets and consistently achieves an ROIC of greater than 25%.
25%. That is an exceptional return, especially in a service business.
It is. And the power of that number is only visible when you contrast it with their cost of capital. KPG maintains a moderate debt load, so if we factor in their cost of debt and equity, we can conservatively estimate their cost of capital is somewhere around 8 to 10%.
So they borrow or raise money at, say, 9%, and they can immediately reinvest it at 25.
Exactly. The resulting spread is a massive 15+ percentage points. This spread is the fundamental driver of shareholder value. Every dollar they reinvest returns 25 cents while only costing them 9 cents. It's the definition of a high-quality compounding flywheel.
And this high ROIC directly informed their most crucial recent decision, the capital allocation pivot.
This is where the average investor might see a red flag, but a more sophisticated one sees discipline.
Here's where it gets really interesting. In fiscal year 24-25, KPG management made a decisive, highly counterintuitive move. They suspended dividends entirely. Previously, the stock had yielded a modest but consistent 1 to 2%. For many legacy investors, a dividend suspension is a panic signal. It suggests financial distress or slowing growth. Why, in your assessment, is this actually a sign of deep financial discipline?
It is a supremely rational move. It's the kind of thing you see from what we call outsider CEOs, leaders, focused purely on maximizing long-term shareholder returns through superior capital allocation. CEO Brett Kelly's primary job is capital allocation. The logic is simple and cold.
Which is?
If the company can consistently reinvest every single dollar of free cash flow back into the business and earn a 25% return on it, why on earth would they pay it out to shareholders as a low-yield, tax-inefficient dividend?
Right. The shareholder immediately pays tax on that dividend, and then they have to go find another investment that might earn them 25%. Good luck with that.
It's just. The compounding math overwhelmingly favors immediate, internal reinvestment. The decision signals management's confidence in their ability to maintain that 25% ROIC on new acquisitions. It tells the market,
Hmm.
we believe we have deals that are 25% accretive, so we would be financially negligent to pay you a 1% dividend.
But there's a huge caveat there.
A non-negotiable caveat. This strategic pivot only works if the reinvestment succeeds. That means the aggressive U.S. expansion absolutely has to pay off at high margins.
Which takes us directly into the heart of the growth narrative, the sole justification for that 38x valuation. The story hinges entirely on the success of the U.S. push.
Let's look forward. The core growth engine for the next decade is this programmatic roll-up, but the geography has shifted massively. KPG aims to replicate its highly successful Australian blueprint in the United States market.
And the U.S. market size isn't just a little bit bigger than Australia's.
Not at all. Sources indicate the U.S. professional services accounting market is estimated to be roughly 10 times larger than the Australian market. This is an immense greenfield opportunity for a disciplined acquirer with a proven, systemized model.
That makes the total addressable market, or TAM, effectively infinite for all practical purposes.
It is. The U.S. accounting market is hyper-fragmented. There are hundreds of thousands of independent SME accounting firms, many run by aging partners looking for an exit strategy that protects their legacy and their clients. It's a perfect setup for the 501(c)(49) KPG model. If they can capture even a fraction of a percent of that market, the compounding is just spectacular.
So where are they starting? Where have they established their initial beachheads?
They've been very strategic, focusing recent acquisitions in high-density, business-rich geographies, Florida and California. These areas offer diverse economies and a high volume of potential targets. These first few deals serve as a crucial proving ground.
The canary in the coal mine.
Exactly. For whether the Kelly business system and critically the KPG culture can function effectively on foreign soil.
Okay, so if the TAM is infinite, and they have the capital discipline from the dividend suspension, what's the actual constraint on their expansion rate? What stops them from buying 100 firms a year?
This is the critical reality check that separates the dream from the execution. The constraint is not capital. It's not deal flow. It is fundamentally managerial bandwidth and cultural integration.
Explain that.
KPG's success depends entirely on quickly integrating new firms, installing that complex Kelly system, training local staff, and maintaining the crucial 5149 cultural alignment. If they grow too fast, they risk diluting the culture and local partners start resisting the standardization.
And the integration team gets overwhelmed.
Right. The KBS installation becomes sloppy, and those critical 30 to 35% margins immediately start to drop. Growth that comes at the expense of margin is value destruction. The speed of growth is dictated by the speed of high-quality integration.
Which leads us directly to the potential points of failure, the key risks that could shatter this flawless execution narrative priced into the stock. We need to do a deep pre-mortem.
Okay. Risk number one is the kill scenario, deworsification via U.S. expansion. This is where that core process power moat is rigorously tested. The U.S. operating environment is profoundly different from Australia's.
Let's dig into that. Why is the U.S. tax, regulatory, and labor environment such a big risk compared to Australia?
The differences are manifold. Tax law is significantly more complex. You have overlapping federal, state, and sometimes municipal regulations that vary wildly from place to place. Labor laws and compliance are far more state-specific. California's labor laws, for example, are unique and incredibly onerous.
So the system has to be adapted.
It does. The ultimate question KPG has to answer is, does the centralized Kelly system, which works perfectly in Australia, function smoothly and efficiently in this fragmented U.S. landscape? If the implementation costs are higher, or if they're forced to deviate from the system, that margin advantage just evaporates.
So if they acquire U.S. firms, install the KBS, but find that the U.S. margins only come in at, say, 20-25% instead of the Australian 30-35%.
Then we know the process power is local, not truly global. That's the acid test. If they start burning cash or acquiring low-margin businesses, that prized 25% ROIC gets destroyed immediately. The compounding story stalls, and the multiple collapses.
Okay. Risk number 2 centers on the human element, specifically at the top.
Risk number 2 is key man dependency. CEO Brett Kelly's vision, his intense focus on capital allocation, and his personal cultural force are absolutely central to the whole operation. He's the architect of the 5149 model and the standard bearer for the culture of performance.
So if he were to suddenly leave, the risk isn't just about losing a competent CEO, it's about the underlying decentralized federation structure fracturing without his centralized vision and discipline.
That's the danger. Roll-ups of human capital are inherently fragile. The system relies on the founder's motivation and the exec team's rational capital allocation. A sudden leadership change could lead to internal tensions exploding. Or a successor might revert to a less disciplined strategy, maybe restoring the dividend to placate shareholders, which would be fundamentally value-destroying at this stage.
And finally, the financial structure risk, especially for a roll-up in a high-interest rate world.
Risk number 3, rate sensitivity. KPG, like any serial acquirer, relies on debt to fuel its acquisitions. Now, to their credit, they've been prudent. Their net debt to EBITDA is moderate, around 2.0 times. That's manageable. But if interest rates stay elevated, the cost of that debt increases.
Which directly squeezes the profit spread on new deals.
Exactly. If their cost of capital rises from, say, 9% to 13%, that crucial 15% spread between their 25% ROIC and the cost of capital narrows dramatically. New deals become far less accretive, and the compound engine just slows down. They need that spread to stay wide to justify the valuation.
Okay, so we have a high-quality model, but immense execution risk and a very high price. Let's bring it all together. What does this mean for the price the market is currently demanding? Is there any margin of safety?
The market has unequivocally baked in the maximum amount of future success. Let's just reiterate. The current price is $8.75 AUD, and the corresponding 38x underlying PE is pricing KPG as a flawless, high-growth compounder. It demands perfect execution of the U.S. strategy and perpetual maintenance of that 25% ROIC.
So we need to triangulate the intrinsic value to see where a rational price ceiling should be. Let's start with the discounted cash flow model.
A DCF is the most appropriate measure here, but the assumption set has to be incredibly optimistic to get anywhere near today's price. If we assume they maintain that high ROIC and we project 15% free cash flow growth for the next 7 years, there's a phenomenal run, and then stabilize to a 3% terminal growth rate, the intrinsic value comes out to about 750 cents AUD per share.
Okay, so $7.50 is the optimistic scenario, yet the stock is at $8.35. That's an 11% premium to the optimistic valuation. What about using a historical mean? What's a standard premium for a high-quality serial acquirer?
Historically, for high-quality, disciplined serial acquirers with proven systems, a normalized multiple of around 25 times earnings is often considered a fair premium entry point. If we apply that 25x multiple to KPG's estimated forward earnings, it suggests a valuation range of about $6 to $7 AUD.
A significantly lower entry point. That range reflects what a justified premium for quality looks like without demanding total perfection.
And finally, what's the professional analyst consensus? They tend to focus heavily on that execution risk.
The street targets are, as you'd expect, conservative. They're reflecting deep caution around the U.S. execution risk we just detailed. Analyst consensus targets range from about $5.80 on the low end up to $7 AUD.
So we've triangulated a clear intrinsic value range between $5.80 and $7.50, depending on your level of optimism, yet the stock trades at $8.35.
The final verdict, then, it has to be clear. Let's synthesize the quality and the price.
The final verdict is definitive, I think. The quality score is HEH. The economic moat created by the 5149 owner-driver model and the process power of the Kelly business system is genuine. It's robust. It translates directly into superior margins.
Okay.
But the valuation score is expensive. At the current price of $8.35 AUD, the stock is pricing in absolute faultless execution of this ambitious, high-risk U.S. expansion. There's currently no margin of safety for an investor. The market has already awarded KPG the compounder premium, leaving zero room for error.
This raises a really important question. The business is magnificent, but the price demands zero mistakes, which just doesn't happen in the real world of M&A. We always like to end with a red team challenge for you, the listener, the ultimate synthesis of risks to consider before you accept that 38x valuation.
The red team challenge forces you to question your most fundamental assumptions. The primary challenge here is accepting the cognitive dissonance. You are effectively buying a highly people-dependent service business at multiples usually reserved for asset-light software companies. The margin of safety you'd usually get from cheap assets or a low valuation just isn't here.
And that competitive advantage has to be proven all over again against the biggest market in the world.
Yes. You have to ask yourself, is the Kelly system truly a proprietary global advantage, a true process moat? Or is it just a very well-executed Australian operating manual wrapped in great marketing? If the margin drop-off in the U.S. is substantial, the whole process power thesis dissolves. The U.S. expansion is the crucible.
And the final, most crucial challenge, the ultimate test of that 5149 model in a real economic downturn.
This tests the loyalty of the Federation. When the inevitable U.S. recession hits, or if the Australian market slows down, will those 49% partners, who are still entrepreneurs focused on their local P&L, truly remain loyal?
Or will they refuse to absorb the temporary pay cuts needed to protect KPG's centralized 30% margins?
If those local partners push back, the friction increases, the system breaks, and the federation model fractures. We've seen that pattern before. The moment centralized cash flow slows, internal tensions in a federation can explode.
So the question you're left with is this.
Is the intense outsider-style discipline of KPG management, which we've praised, is it enough to completely overcome the inherent messiness and systemic risk of managing human capital, especially when you are paying 38 times earnings for it today?
That is the ultimate thought experiment. If you're on the sidelines, the focus shifts entirely to the price. Is the potential reward of this flawless growth scenario worth the risk of paying a 15 to 20% premium to the high end of the estimated intrinsic value?
I think the smart money waits. You're waiting for one of two things. Either the price drops sharply, maybe into that $6 to $7 range, offering a genuine margin of safety, or management executes so flawlessly in the U.S. that the intrinsic value itself races up over the next 12 to 18 months to meet the current price. It's an exceptionally high-quality business to watch, but a highly priced and high-risk one to own at these levels.
A compelling deep dive into the nuances of professional services compounding and the terrifying demands of a high valuation. Thank you for walking us through that complex structure.
My pleasure. It's a study in how structural advantage can lead to extraordinary returns, but only if capital allocation remains perfect.
And to you, the learner, we hope this rigorous synthesis of the financial structure, the unique incentives, and the critical U.S. expansion risks helps you understand the gap between quality and price, and whether KPG is a high-quality compounder or a valuation trap. We'll see you next time.